Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the weekly economic review for the week ending April 9, 2021. So, as usual, we are joined by our chief economist, Clément Gignac. So, good morning, Mr. Gignac.
Good morning.
So, just to change things up a little bit, I will be covering the financial markets and you will be covering the economy today. So, I'll start maybe with an overview of the markets on the week. So, as you can see, not much red on the screen. So, it was positive for bonds, lower interest rates on the week. It seems we have a bit of a respite here, at least a pause on the rise in interest rates. So, that favored bonds, but it also favored equities. It gives a break to the market. So the Nasdaq was first. Then you have the S&P 500 and EFI nose to nose, the TSX, and then emerging markets. Year to date, still very positive on equities, still very negative on bonds. On the week, we're back to $60 on the price of oil. The Canadian dollar suffered a little bit, minus 0.10%. The euro was up, and gold also was up on the week, 1.5%. So now to discuss the economy, Clément, hand it over to you.
Yeah, thank you, Sebastien. As usual, we start with the COVID, an update on the current situation. So we can see that in Canada is pretty evident, but we see as well in US and so an increase of the number of cases. This chart is about the daily new cases per million population in order to be able to compare apple with apple. So that's the reason we use that ratio. This is a 7 days moving average. So we can see with the new variant that we have some acceleration of new cases in Canada. In US, we see some acceleration as well, but look like much lower as we speak than what we have seen late last year. But keep in mind that the vaccination campaign is going at faster pace as well in US than in Canada or in Europe. So that explains probably why that we doubt very much that the new variant will create a third wave as big as the second wave. But it's not a precise science. We know that since the beginning of this pandemic, we learn on the almost on daily or weekly basis. So we will see. It's a risk factor, no doubt about that. On Canada, just an update on vaccination rollout. In fact, that you can see that we've close to 16, 17% in Canada. So we shift from the first gear to the second gear. Quebec continue to lead the province in Canada. It's close to 20%. So it's very, very encouraging. On the next slide, it's about the IMF. The good news, they revised their forecast once again. So you have a lot of bars. Sorry about that. The black one represent the expectation of the IMF regarding forecast of 2020 to 2021 compared to 2019. So if you remember summer a year ago, the IMF thought that we will be remain in the basement for a while in terms of economic activity. Finally, they're getting more optimistic with the good news about the government stimulus and central banks liquidity. Better news in January with the good news of vaccine, that they have some efficient vaccine to show up, and even more stimulus from the U.S. And notice now in U.S., for example, compared to Europe. So with the vaccination campaign we're running very well in U.S. and with the stimulus from Mr. Biden, 1.9 trillion earlier this year. So now IMF predict that this year the level of economic activity in U.S. will exceed the pre-pandemic level. So it's very, very encouraging. So U.S. Lead the pack, no doubt about that. You can notice on next chart. They expect for on the next slide. They expect, in fact, that U.S. This year will have a 6% growth, 6.4% growth. So clearly, U.S. lead the pack. So this is all the G7 compared to our starting point 2019. So you can notice the significant recession that we have seen, but the significant recovery. 6% predict 6.4 for 2021. So that means that in 2021, the level of economic activity in U.S. By year end will exceed by 2.5% the level of pre-pandemic. So very interesting. Notice Canada, not very far from U.S. So and they will catch up later on in the next 2 years. So very encouraging. That not include the fiscal budget upcoming in February in April 19. So we'll see what will be the forecast. But for the time being, they expect 5% growth this year in Canada compared to 6.4 in US, and next year they expect a 4.4 in Canada. So it's very encouraging. Europe, they lag definitively. The stimuli has been less significant in Europe than in US or Canada. In addition, the vaccination campaign is much lower out there than in North America. So we will see. But I found that very interesting to share with you that good news from the IMF. Shifting topic, talk about wages, inflation. No doubt that it will be an issue in the coming quarters and next 2 years. You will hear more and more about inflation expectation, wages inflation. So far, wages have not accelerated too much, but we will see. The first chart here is a survey from the National Federation Independent Businesses. So clearly, they have two curves. The blue one, which is dark, represent the job opening hard to fill. So you can notice that even if you have 8-10 million people unemployed in US, they have a lot of people who have not the skill to fill the job. So suddenly you have a shortage of labor despite you have 10 million people unemployed. Could you believe it? It's because it's some sectors you have a lot of layoff, but other sectors you have shortage of labor, but you have a skill mismatch. And it's hard to match the skill if you want in some sector, despite the unemployed people. So the question would be, notice the other curve, it's the compensation. So is it a possibility? Because the relationship has been very close in the last 2 decades. You can notice that 2 decades history on that chart. That if you have difficulty to fill the job, believe it that you will see pressure, upward pressure on wages. So compensation will accelerate. So this is an issue because clearly, notice on the right side, it was the unemployment rate, yes, the NIRU, but the impact on the core inflation. In the 60s, during his 5, 7, 6 years, they have no pressure on wages, no pressure on inflation, and suddenly, all of a sudden, inflation start to accelerate in the late 60s. So this is a parallel that we have to watch. If it's relevant or not, time will tell. But this is something that the market will become more and more nervous about wages, possible acceleration, and inflation expectation. And it will be the key for central banks to stay on the sideline or maybe pull the trigger before 2023 if you want. Next slide, it's about the good news that we have in Canada. So this is Friday morning as we record, and the job creation has been released. The expectation has been 1,000 jobs expected to be created in March. Guess what? It was above 300,000 jobs and 175,000 being in full time. Very encouraging what we see in Canada. Notice the red curve is Canada, the blue curve is US. Canada almost recovered 90% of job loss during this pandemic. Okay, it's not the same job to be created, make no mistake, but we are returned close to the level of pre-pandemic. It's a long shot in US. We are only at 62% of the job loss, job level to be recovered. So we will see. But I found very interesting to show that despite the fact that vaccination campaign in US is accelerated at faster pace in Canada, that it seems that the Canadian labor market structure notice that we have a better educational background, the number of people who has degrees, university and post-secondary is more higher in Canada than US. So possibly this mismatch of skill, it's easier to fill in Canada than US. This is interesting. It's a story under development, to be honest, and they will have an impact on the Canadian dollar. The Canadian dollar, because it's a possibility that you see Bank of Canada remove liquidity before the Federal Reserve. If it's right, if it's the case, and our optimistic proven to be right, expect the Canadian dollar to reach 83, 84 cents in the next 6 months. This is our optimism. We hedge partly of the funds we manage, Sébastien and myself. We are very optimistic on Canadian dollar. We will see. And finally, on real estate, they have a lot of discussion about real estate. Is it a bubble or not? The CEO of Bank of Montreal has mentioned that we have to do something. They push on Ottawa to do something. So time will tell if it's a bubble or not. I'm not sure it's okay. It's speculation. Speculation. Some part is a fraud, maybe market, overeating market. But is it really a bubble? Keep in mind that the COVID-19 is a game changer. A lot of people realize that even after vaccination, they will be able to work maybe 2 or 3 days a week from home. So that changed the priority. Housing become a top priority in some circumstances if you work 2 or 3 days a week at home. So that means that you are most often at home than the office, which is the opposite of before COVID-19, and the demand is very strong for housing. Uh, in any case, in Canada, we have different tools to if you want to fight the overeating market. So they have a macroprudential tool. So OSFI, in fact, has decided to increase the stress test. So this chart illustrates the behavior of the housing in Toronto, home price in Toronto. Notice 2017, 18. At that time, they have a lot of things going on with in fact, the foreigners who buy housing in Toronto. So at that time, the Ottawa has introduced a stress test, 200 basis points, that if you want to borrow from a bank or financial institution, even if interest rate low is very low, you have to qualify for the mortgage. So they add another 200 basis points to double check if you are able to make your payment, assuming that interest rate will increase. And they have an impact, but it was temporary. In addition, at that time, the Bank of Canada pulled the trigger and increased interest rate. This is not the case right now. Bank of Canada have no intention anytime soon to pull the trigger of interest rate increase. So I doubt very much that if you increase another 46 basis points on the stress test to be 525 rather than 479, that will make a big difference. So we will see, but expect probably other action from Ottawa to fight this overeating situation that we will have. So I was long a little bit, Sébastien, talking about capital markets. So back to you.
Sure, thank you. So financial markets, it was a bit of a slow news week. So I thought that maybe I'll take a look at the bigger picture here. So as Clement mentioned, the economic news are actually pretty good in the U.S. Growth is strong, should be strong, should stay strong for a while. So we're always asking the question, and it might seem like a funny question, but are news too good for the markets? So this is the question that we're asking. So here, this is for the US. On the left, you have the ISM US Manufacturing Index. As you can see, you see the history since 1990. So you see all of the peaks where you have the little red arrows. Now the question is, are we at the peak, or is there more room for it to grow? So this is a question, but it's still pretty elevated. On the right, what you do see is the relationship between the forward returns on the S&P 500 after 3 months, after 6 months, and after 12 months, depending on the level of the manufacturing index in the US. So what it tells you is that, well, when you're in the middle of the series, so when you are growing but you're not at the peak yet, usually looking forward, you have very good returns on the markets. But when you're pretty high, pretty elevated, like we are now, between 60 and 64, well, in the short term, you can have negative returns, you can have lower returns, or at least you can have some volatility. So this is why we do expect that this year, even though we'll have very strong economic growth, the fact that we had 75% return on the S&P 500 between March 2020 and March 2021, well, a lot of these good news are already in the price, so there might be less room for strong gains on the US stock market. So that doesn't mean that you'll have negative returns on the US stock market this year, in the next few months. You never know. Market timing is not easy, but it does encourage us to start looking elsewhere, and we've been discussing that for many weeks now. We do think that Canada, Europe, Asia and emerging markets will make for better markets, better returns in 2021 than in the US. So maybe first in Europe, it seems that the market has been hitting its head on the ceiling for over 20 years. As you can see, the peaks of the late 1990s, the mid 2000s, and the mid 2010s. So as you can see, it seems like there was some resistance there, but we're finally breaking out of that range. So that's a good signal. That might be a bit technical, and this is only for Europe. But if I broaden it further, next slide on EFI, so Europe, Asia, and Far East, what you have is that you have a market that is cheap relative to the US. So the chart on the left, you have the next 12-month price to earnings for EFI divided by the one in the US. So now you're very low. So that means that you're very cheap for if you're invested in the market is very cheap in Europe and Asia compared to the US. And on the right, you see that in 2021, the growth rate of earnings that is estimated by the consensus is even better in Europe and Asia than in the US. And in the US, it's not a low rate, it's 25%. You see that the blue stick on the right. But in Europe and Asia, we're talking about 35%. So if you have a market that is cheap and earnings that could be outgrowing the US by 10%, you have a good combination of margin of safety and momentum to be invested in Europe and Asia. 2022, close to nose, but with an advantage to the S&P 500. So with 2021, we think it's a good time to be invested in Europe and Asia. So what to watch next week in the data? Canada will have manufacturing sales and housing starts. Data should be coming strong again. Now we know that we were reopening early this year, but in April we kind of went to a stop with the new lockdowns in mostly in Ontario and in Quebec. So we could have strong data coming in, but we are expecting data to slow down somewhat in April. So we'll see when we get this data, probably somewhere in June, we'll start to see April data coming out. In the US, we'll have the inflation figures, we'll have retail sales, industrial production, and housing starts all have strong momentum right now, and with a special emphasis on the inflation, of course. So that wraps it up for the week. So ia.ca/economy is your go-to web page. You can subscribe to the newsletter if it's not done already. You can ask for a PDF version of this presentation if you want it at economics@ia.ca. Just send us an email and we'll send it to you. So thanks everyone for being with us again this week. Thank you, Clement, for your knowledge.
You're welcome and have a nice weekend.
Thank you. You do. And we'll be back with another edition of the Weekly Review next week. Thanks, everyone.